What type of coverages are there available for anybody? Anybody?
We've talked about, mentioned a couple things. Kevin mentioned term insurance, and I think a lot of it, what it comes down to is what is the purpose of that life insurance. So, maybe you have some short-term need, like if you were to die early, you would want to fund your child's college education. You would want to pay off that mortgage. So some of those would be more on the short-term needs. Those long-term needs, we got into some of the estate tax issues and those types of things. So to fund those short-term needs, from a cash outlay standpoint, a premium standpoint, term insurance is very effective in those scenarios. When you've got something that once you live past that need, you've then taken care of that. That term insurance, whether it's 10 years, 15 years, 20 years, would take care of that. And then you move sort of down the line into more permanent insurance or that cash value life insurance. Universal life would be a good example of that, and I think is somewhat of a moderate step on your way all the way to whole life. But universal life is run off of an interest rate or is credited off of an interest rate, but is a certain type of cash value life insurance.
So it's related to the market, actually.
That is true. It can be, and there are some variable universal life policies that are even more tied to, and I'm sure we'll get into that, but are more tied to the market, where they actually have sub-accounts that they work off of that are tied directly to the market. And then, lastly, I think you have whole life insurance, which is funded by the dividend, from an insurance company. And again, those a lot of times you have faster growing cash value inside of those policies, and also a lot more potential for a growing death benefit in that situation.
So among all these policies, you said term insurance and UL, universal life, and anything else, the cash value, which policies would have the cash value in it?
The universal life would most of the time have cash value in it. There are some what's called secondary guarantee universal life products, which maybe have minimal cash value, but there are cash values associated with universal life, with variable universal life, which we touched on, and also within whole life policies.
Whole life policies. So how is this cash value generated within these policies?
Well, we touched on that briefly. Again, in the universal life, just strictly with a traditional universal life policy, it's based off of an interest rate. And that's how that cash value builds inside of that policy, is off of a given interest rate. In today's environment, that interest rate may be a little bit lower. Now, if you were to talk about 15, 20 years ago, that interest rate would have been a lot higher. Now, you have to be careful a little bit with universal life policies and how you structure them, because they're so heavily based off of that interest rate. If you were to base all your calculations and how long the policy was going to last for off of a higher interest rate, and you got less, you could potentially get into some trouble there. So you want to make sure you're working with a financial planner that understands how that works to make sure that it's funded properly.
Okay.